Welcome to Concept Craft. We are presenting step-by-step videos training to crack your certification exam, so you can gain the confidence to take on any accounting challenge. Now let's begin our today's lesson. Troubleshooting inventory balances. Learning outcomes. In this lesson, we'll cover troubleshooting inventory balance issues in QuickBooks Online. Topics: troubleshooting inventory balance discrepancies, troubleshooting negative inventory balances, getting balances back in balance. Many businesses rely on QuickBooks Online's inventory tracking feature, which uses the first in, first out (FIFO) inventory method. This means that QuickBooks Online always considers the first units purchased to be the first units sold. It then adjusts inventory and cost of goods sold (COGS) accordingly when an inventory item is sold. Everything works in harmony most of the time, and the balance on inventory reports matches those on the balance sheet. However, the balances occasionally don't match. When that happens, how do you find out the extent of the problem and get things back into alignment? How can you and QuickBooks Online help? You're likely to notice balance discrepancies when you run and compare relevant reports in QuickBooks Online. You can analyze these reports to identify any recording inaccuracies and poor workflow, and then work with your client to fix these issues. Your first step should be to run a balance sheet report. Let's start by looking at this. Troubleshooting inventory balance discrepancies. At period end, you must compare inventory reports with the balance sheet. If these don't match, check for any inaccuracies in the recording by identifying transaction lines coded to the inventory asset account without a specified inventory item. Step 1. Run a customized balance sheet report. To do this, run a balance sheet report, then select the dollar amount for the inventory asset. This will open a transaction report for inventory. Select Customize. Choose all dates from the report period dropdown. Scroll down to the filter section and check the product/service box, then choose Not Specified from the drop-down filter. Select Run Report. Because you selected Not Specified from the product/service filter, this customized inventory asset transaction report will show transactions that post directly to the inventory asset report and don't use items. Step 2. Review and edit transactions. Review the transactions to determine if they should be reclassified to another account or corrected to include the inventory items. Also, check the transactions to see if you need to adjust inventory quantities. What if there are too many transaction errors? Suppose the number of transaction errors is too large to correct one by one. In that case, you might determine that an inventory quantity adjustment is the most appropriate way to adjust the error. Due to the FIFO layer's COGS effect, you must determine for what period, for example, monthly, you must create the adjustment that will result in an accurate cost of goods sold. Troubleshooting negative inventory balances. QuickBooks Online allows your clients to sell inventory products to their customers in sales forms even when there isn't sufficient quantity on hand. This means that the client is, in effect, selling stock that they don't have, in anticipation of getting more supply. However, doing this makes their inventory for that item go negative. When your clients record an invoice for sales of a product they don't have in stock, QuickBooks Online has to guess the cost based on historical purchases. If there are no historical purchases, QuickBooks Online uses the amount in the cost field for that inventory item. If there are no historical purchases and no cost amount for that inventory item, QuickBooks Online assumes a per unit cost of 0. QuickBooks Online then records the cost as a decrease to inventory asset and an increase to cost of goods sold. This allows the invoice to be recorded but can lead to other problems. Select each heading to learn more about resolving negative inventory balances. How do negative balances arise? A negative balance can emerge when a client records an invoice for which not enough inventory is on hand. In this situation, QuickBooks Online will automatically adjust the cost of goods sold, COGS, on the previously entered invoice based on the new purchase cost. It does this regardless of whether the purchase is dated before or after the invoice that recorded the sale of negative inventory. If the invoice is dated in a prior period, the numbers for that period could also change. Problems can also occur if the quantity on hand is never appropriately replenished. The inventory asset value and costs are not reliable because they are based on QuickBooks Online's estimate at the time the sale and cost are recorded. How can you identify negative balances? Negative inventory balances will show on the client's products and services list or inventory valuation summary report. Both of these can help you identify any items with a negative quantity. You'll see total inventory counts in the inventory valuation summary report's quantity column and the quantity on hand column of the products and services list. If you find negative total inventory, run an inventory valuation detail report for that product. The QTY column represents the count of products bought or sold on that transaction. The QTY on hand column represents the running count of product on hand. Review the transaction detail for the negative inventory products to find how far back the negative inventory quantity goes. How do you fix negative balances? Work with your client to determine whether this is a current issue easily resolved with a vendor bill or check, or whether this involves adjustments to prior periods. Remind your clients that they should verify they have sufficient quantity on hand before recording sales. Explain that negative inventory can lead to skewed financials, even when purchases are made after the invoice date, which over time corrects the cost of goods sold, COGS. Skewed financials create problems when they straddle month or year ends and when the client uses profitability reports to decide on price changes. Other consequence of negative inventory. One significant consequence of having a negative inventory balance is that, if there is one, then a closing date cannot be set for books at period end. Clients will see an error message when setting a closing date if they have any negative inventory balances. The message will state that the books can't be closed with negative inventory and list the items with negative balances, as shown below. In these instances, you or your client will need to adjust the inventory balance before setting the closing date manually. Summing up. Learning outcomes. Well done. In this lesson, we covered troubleshooting inventory balance issues in QuickBooks Online. Knowledge recap. You can now help your clients resolve discrepancies between the balance on an inventory report and the amount on the balance sheet. In most cases, reclassifying the problematic transactions fixes this problem. Next steps. In the next lesson, we'll look at preparing and filing 1099 forms.